Hey everybody, welcome into the podcast. This is Retirement Approved with Matt and Steve Paul joining me here. We're kicking off a brand new podcast with these guys. Looking forward to talking about investing, finance, retirement, maybe some sports, all sorts of different things. We're going to throw a bunch of stuff in that. But the guys are here once again to chat with me and get things going. Of course, you can find them at R.W. Paul and Associates. I know it's Richard W. Paul and Associates. But you can find it at rwpaul.com, and we're going to have this on Apple and Spotify and YouTube and all sorts of good stuff. So looking forward to talking with the guys. Guys, welcome into our first podcast here on Retirement Approved. Matt, how you doing, buddy?
Episode number 1. I am excited.
I know, right? We've been trying to get this together for a while, so looking forward to it. And got my old buddy Steve back here. Used to do radio with Steve a few years ago, so good to see you again, my friend. How are you?
I'm doing great. I'm excited to do this. Matt was trying to convince me. He's like, we should just continue the radio show. And it's like, no, we need to get Mark behind the camera. Look at that face. Face needs to be seen.
It's not a face for radio.
That is not a radio face. No.
Well, good to have you guys here. Looking forward to chatting with you. We got some good stuff lined up, so we're going to start doing these a couple times a month. We'll drop out some good content. Like I said, you'll be able to find it in audio form on Spotify or Apple. We'll also have it in video form on YouTube. We'll have some shorts out there as well, those little short reels and things of that nature. So a lot of good stuff. Like I said, we'll try to keep it informative, but also have a little fun along the way too. What you guys do is obviously super important, so we're going to have a good time with that. And this first episode, guys, let's just talk a little bit about 2024, right? So we're dropping this to start February. We're getting it all set here in January, and we're dropping it in February. And, how should we be positioned? What are some things to kind of think about as we kick things off for the year?
Yeah, that's what we're going to talk about this episode. We got three main topics we're going to hit. We're going to talk about the election. We're not going to get into politics, but we're going to talk about the election and what you should do with your portfolio there. We're going to talk about equities versus fixed income, and then we're going to talk about what everybody wants to talk about right now, which is cryptocurrencies and Bitcoin. So stay tuned for the end of the podcast for that. But really, this whole concept of retirement approved. Steve and I started a book 5 years ago now, 2019, and we sent it into editing in 2020. And then what happened, Steve?
Then the pandemic happened.
Some little thing, right? It wasn't.
Let's see how this plays out.
Yeah.
And then by the end of the year, going into 2021, we went, gosh darn it. We're going to keep the show PG, by the way. Gosh darn it. We're going to need to rewrite this whole book.
Yeah.
So we're finally done with that. It's going through the final editing right now. They're working on the artwork for the front cover. We should have that out by the end of next month, end of February. So that'll be available for all of our clients. If you want one, just reach out to Abby. We'll have them stocked at the front desk, so you can grab one when you're in. But we're really excited to have that done, and we're really excited to get this started up. And like Mark said, we're going to try to do this every other week if we can. Mike and Beppen do a great job on the thought of the week. But in addition to that, Matt and I are just going to talk about what's going on in the market. We're probably in store for a pretty crazy year with the election and everything. So we want to make sure if there's any scare tactic-y headlines out there, any fear-based headlines that people are clicking on, we give you our thoughts on that as well. And for our clients, if there's any questions you have, email them in. We'll be happy to address them on the show and talk about that as well.
Yeah, absolutely. And we'll give out the information in the show notes. You'll be able to go in and check that stuff out. So if you do want to reach out to Abby, as he mentioned, get a copy of the book, things of that nature. We're actually going to have a little promo that'll pop up here in the show with a cool picture of it and telling you some more things about it as well. So that way, if you want to get yourself your little hands on that, you can certainly do it. And we'll keep it PG-ish. Maybe we'll push for PG-13, right? Sorry to say PG-14, but I don't think there is a PG-14. But either way, well,
we're going to have some fun. That's for sure.
That's right. So let's jump in, right? So let's talk about a couple of things. So in December, as the year was winding down in 23, the Fed came out. Chairman, they got together. They did their powwow, right? And they came out and said, we're probably going to cut rates in 2024. So that looks like that's on the horizon, but I don't know. What do you guys think is going to happen there over the next, year and a half?
I do think they should rename the FOMC meetings to powwows. Powell's powwows.
Powell's powwows, right? Yeah, they should make that. Let's make that a podcast. Powell's powwows.
So what they've done is that they've signaled that at some point they're going to be decreasing rates, whether that's at the upcoming meeting, whether that's mid-year, later in the year. We know it's coming at some point. We'll get into that a little bit more when we're talking about fixed income. But what we'll start off right now with is politics, everyone's favorite subject.
Oh, we've got strong opinions too.
Now your dad's not on the show, so that changes it a little bit, but
he is not. So we're not going to get too political here, but we do want to address one of the major questions we're getting. That's, we're in an election year. Does it really matter if a Democrat is elected, a Republican is elected? And Beppen did a great job touching on this in the market update, but we want to revisit it.
Yeah, please.
So Matt, I know you got a couple charts. Why don't you throw them up?
Yeah. So really what people are talking about when they're mixing politics with their planning is getting out of the market. So if a Democrat gets in, I'm going to get out of the market. If a Republican gets in, I'm going to get out of the market. Really, if my team loses, I'm going to get out of the market. Move to Canada. We always hear that one too. So really, the chart on the screen is showing, what if you actually did that? What if you said, hey, you know what? My guy lost. I'm just not going to participate in the market for the next 4 years. Well, going back since 1949, you would have underperformed the market. You wouldn't even have $500,000 when the market would give you over 3 million, especially updated through 2023. So that just shows you don't need to play that game. You don't need to say, hey, I'm going to sit on the sidelines and wait for a better buying opportunity because my guy lost. It's just not how investing works. And
certainly not an indicator you want to follow.
But the markets do tend to do better overall in an election year, right? There's some interesting historical data there, right? Like last 20 elections or something like that, they tend to be up.
Yeah, this next chart shows just that, and I'll let you take it away, Steve. It shows each election year. So the darker the shading, the darkest shaded one is the first year, and the lightest shaded is the fourth year. And we're in the fourth year of a president's term. So
it just shows you it's not an indicator you want to follow. Time in the market. And that doesn't mean in our portfolios that we aren't making adjustments, that we aren't locking in some gains, that we aren't moving maybe some more into fixed income. We're doing that. We're just not bouncing in and out of cash. That's crazy. It doesn't make any sense whatsoever. So there's different indicators that we're looking at. We're very concerned about inflation and what the Fed's going to be doing coming up. And there's probably going to be, a few months, maybe longer than that this year of some volatility. But we are not looking to move into cash and possibly miss out on any type of growth.
Yeah. Our motto is keep politics out of planning, as hard as it may be. Yeah. I know it's an emotional subject, and you'll see a lot of headlines, a lot of markets in turmoil segments talking about how it's crashing the market, this, that. You just got to ignore the noise.
Yeah. Michael Burry coming out with his doomsday predictions and then going, oops, got that one wrong. Sorry about it.
Right.
It just shows you that nobody truly knows exactly what's going to happen. And again, we are making adjustments within our models. And we are locking in some gains, but we are not looking to move a significant portion into cash.
That's funny that you say that, Steve. I just saw where our good friend Harry Dent, and we used to talk about this a little bit back on the radio show a number of years ago. I think for 2024, he came out and said, yeah, it's going to be the biggest crash we've ever seen in our lifetime. And it's like, well, there's nothing like an inflammatory headline. I mean, there's one thing to say, I think it's going to be a down year or even a crash or something, but to say the biggest one in our lifetime is a pretty bold statement, right? So certainly.
But you clicked on it, right?
Yeah.
Clicked on it.
I clicked on it, right?
Exactly.
Fear sells.
So they did their job. Yeah.
That's a lot better headline than I think it might be a down year.
I think it might have
we might see a little bit of chop, and then the Fed's going to cut rates maybe around the summertime, and then we could see a run into the election. You're not going to really click on that. Yeah. But hey, market's going to drop 60%. Just get ready for it. We're all going to be meeting at the pond to go fishing because we're going to get hit by an EMP or who knows what it's going to be. You're going to click on something like that.
We're going to be down the Detroit River trying to catch some fish. I don't know if I want those fish.
With our life straws drinking out of the Detroit River.
That's right. I don't know if I want that fish or not. I have to think about that. All right. So I got some notes here. I got a little ahead of myself when I brought up some different things here. But so I've got traditional 60-40 on my notes here. So, when we're talking about fear sells and be careful of worrying about these things, is the traditional 60-40 still all right? Is that still like something that's, got more legs than maybe we think it does?
Yeah, it definitely does. And if 4 or 5 years ago, we would have been singing a different tune. So we actually were talking about how the 60/40 plan was dying a little bit in 2018, 2019, even 2020 before COVID, because we were in a zero interest rate environment and bonds were doing nothing. So you were getting you weren't even covering inflation with fixed income and cash, CDs, that kind of stuff. But now fixed income's finally attractive. So a 60/40 portfolio is back on the table. It doesn't mean every retiree should just go with a 60/40 blend.
Right.
But it's no longer dead. It's been revived because the Fed has jacked up interest rates and they're now paying a nice yield.
That's like our lions, right? They're no longer dead. They've been revived. Dan Campbell
Exactly.
has come in with the CPR machine and just, and got them rolling. So
there's definitely some correlation there.
Yeah, and I mean, we talked a little bit about that. Gosh, what was it 5 years ago, 4 years ago now? We wrote that silly article, and everyone kind of gave us a hard time over it. You've made fun of that.
The bond bears are out of hibernation.
Hey, I was
Oh.
a little early. I was like 7, 8 months off, but I was right on that one. And yeah, I mean, and a lot of people. So we've been getting questions from clients. Do I really want to go back into bonds? We've had some alternative fixed income that's done really well. Bonds have fallen out of favor over the last few years. They haven't done a heck of a lot. That's kind of what we expected. But going forward, it's definitely there's something that we want to own. I think they're going to do really well. The Fed starts cutting rates. I want a significant portion, especially in the core of a retirement account, in fixed income, because I think not only are we looking at positive returns, I think we could be looking at a couple of years of double-digit returns.
Really interesting. Now, so tech took a beating, obviously, the last little bit here, guys. So what are we talking about here? Are you talking about like the FANG stocks? I guess that's not FANG anymore. I guess that's probably changed a little bit. But what are we talking? I mean, we think, and again, it's all speculation. But do you see in kind of tech making a rebound, or what are we talking?
Yep, tech will always dominate, especially in this environment. We call them the Magnificent Seven stocks now. It's changed from FANG stocks to Fat Man stocks to now we're just going with the top 7 stocks.
I like Magnificent Seven. That's kind of sexy. The Magnificent Seven.
Yeah. But the unsexy part is that they're too heavy. They're too dominant at this point. So if you look at the chart on the screen, this is just the top 5 stocks. So the Apple, Microsoft, Alphabet, Amazon, and now NVIDIA, getting into the AI, GPUs, that kind of stuff. So that makes up 24% of the overall market. You throw the other 2 companies in, you're looking at over 30% in those Magnificent Seven stocks. And that's a major problem. And kind of the default for investors for the last few years has been just throw your money in an S&P 500 index fund or a NASDAQ index fund, call it a day. But the problem is we're continuing to bid up these Magnificent Seven stocks, and they're trading at much higher valuations than the rest of the market, whether you're looking at European stocks or international more broadly, small cap stocks or value stocks. So we've definitely started tilting our portfolios. We're definitely not bailing on these 7 stocks. They're going to be a key to a lot of the innovation over the next decade, but we do not want an over allocation to those stocks like we're seeing right now.
Well, it's easy to say in a year like this, do we want to throw more into tech? Look at the returns that we saw last year. And we don't want to chase last year's returns. Like Matt said, they're now a little overheated. So when I talked about volatility in the first half of this year, we could see that in tech. Those could come back a little bit. And I think as they cut rates, tech I think will do well, but I think small caps overlooked. I think value is overlooked at this point. I think they're going to do very well as well. So we're looking to make a heavier allocation into those sectors and those asset classes.
Gotcha. Okay. So explain this next one here, guys. We got this graph here, this Truflation. What do we got going on here?
Yep, I definitely annoy Steve with this. Every morning when we're having our coffee before we're seeing clients, I pull up Truflation and I tell him where it's at.
I get Truflation text from him at like 5:30 in the morning. I'll wake up to those.
So what this statistic is, it's a little newer. And what the Fed goes off of is the CPI or PCE inflation. And those are based on lagging indicators. We're talking about 30 days old of economic data. What Truflation does is they look at 1 million real-time indicators and they compound it into one number. So that it kind of front runs inflation a little bit by about 30 days, but the correlation's there. It's about a 0.97 correlation. So it's almost like, why isn't the Fed looking at this? Like we have the secret data that's right out in the open, but it's showing that inflation right now, if you look at the true inflation, the Fed did its job. We're looking at sub 2% inflation, so 1.82. And what that tells us is hopefully we see those CPI, PCE numbers get in line with that 2% that the Fed wants. Now, it's not going to happen at the next reporting date or anything like that, but we're hoping that 3.4 number can make its way back towards that 2, and the Fed can start easing off. Because really, every time the Fed increased rates from March of 22 all the way through 23, that takes over a year to work its way through the system. So we're still seeing the effects of all those Fed increases, and it's working its way into that inflation number. And the reason we talk so much about the Fed these days is Powell's powwows. They drive the market.
Yeah, for sure.
There's nothing else you need to pay attention to these days. Of course, you need to look at valuations and earnings and all that.
Right.
But the Fed has been the biggest driver of the market.
Truflation, it's definitely a valuable tool because we always talk about the market, and we let our clients know the market is forward looking. Right? You can't wait until that date where the Fed gives you that news. And this is a great tool because it doesn't guarantee anything, but it gives you an idea of what the Fed's going to be doing. And that's one of the reasons that we brought up fixed income earlier in the show. We think it's going to do really well because we think the Fed is going to cut rates. And I think it's going to be closer to mid-year. I think it's going to be in the summer, but we want to look to take a heavier position in fixed income. And I want to kind of drive that point home. And we didn't really talk about duration. I know you wanted to touch on that as well, because there's a chance to make some serious money in fixed income.
Okay. Well, real fast before you get into that, Matt, I just want to say, Jerome, if you check this out, and you decide to do Powell's powwows, I just send me a little something my way. That's all I'm saying. A little heads up, whatever that might be.
A little royalty.
That's right. Something, right?
T-shirt at least.
At least a T-shirt. I coined Powell's powwow. Something. Right?
We'll make one for you. My wife has one of those Cricut machines.
Oh, there you go.
Press
fantastic. I'll wear it on the show.
So duration, as Steve was mentioning, this is a tricky subject, and we saw banks blow up back in 2023 because they went very, very long in duration. And what happens is when the Fed hiked rates, it's like a teeter-totter. So they hike rates, bond values plummet, and the longer your duration is, the more you're going to get impacted in terms of price. So if you look at an ETF like TLT, that's a 20 plus year treasury ETF. So it's had a lot of inflows, very popular right now just because of the decrease in rates on the horizon. That was down around 50% at one point, which is unheard of for bonds. That was on no one's radar that you could lose 50% holding treasuries. So that's something we actually started dipping our toe into last year. TLT, it's nothing that we're going to say, hey, go all in on this, because obviously there's a lot of unknown risk there. What we've been doing is increasing the duration. So getting out of shorter term bonds and into more mid-term, long-term bonds to get that price appreciation when the Fed does in fact start decreasing rates. And that's why we love Truflation, is that's a good indicator that at some point we're going to see them reducing rates. Now, maybe that number starts going back up and our thesis changes, but for now, that's what we're thinking.
And by no means do we want to go all in. That's just a piece in our fixed income models. So again, a ton of risk. When you say that 50% number, just like your reaction, Mark, our clients are like, wait, what are you saying? Like bonds are like they're like the safe thing. They just, they go up a little, they go down a little, but they're pretty safe, right? Well, not all of them. And you can see as the Fed changes rates, they could move drastically in one way or the other. So again, we're watching it very closely. I mean, it's like, what is the Fed going to do? What are these data sets going to look like? We're going to try to front run them a little bit if we can. But if they start to cut rates, we could see fixed income do very well. So it's not anything we want to ignore.
All right, so we're going to wrap up the podcast here with Matt. You kind of teased it earlier on the show, some of the different things. Of course, I think you listed everything as everybody's favorite, whether it was politics or whatever else. But you mentioned Bitcoin as well. So
everybody's favorite sarcastically for
there you go. There you go. So we got several things here. So we're going to do a little segment here on Bitcoin. How's it factor into things? Obviously, it's still interesting. With what you guys do for a living, obviously you guys serve a pretty wide audience or customer base, right? When we used to do the radio stuff with your guys' dad, a lot of times like, Bitcoin was still in its infancy phases, and also, like anything, don't put too much into it from a retirement standpoint that you don't understand or you can't afford to lose. But I know you guys are taking a different look at things nowadays. So let's just talk about. I think this is probably something we'll touch on fairly often as well. So hit me with the Bitcoin update.
So it like you said, it's an entirely new asset class. It's nothing that we're over allocating to by any means. But there's been some recent news. So on January 10th, the SEC approved Bitcoin ETFs. So what that means is a normal mom and pop investor can log into their Fidelity account and buy Fidelity Bitcoin Fund or BlackRock Bitcoin Fund. There's 10, 11 of them now. And that's kind of scary because that means someone could take their whole 401k, roll it into an IRA, put it all in Bitcoin if they wanted to, and they could lose 80% of their hard-earned money in 6 months.
Wow.
And that's what the SEC was concerned about, is retail going in and saying, you know what, I'm going to buy, look at the returns on this. I'm going to throw 30% of my retirement assets in there and see what happens. That's not what we're looking to do at all. We don't own it in any of our models yet, but it is something that we could eventually look to own. But when we buy it, we're talking maybe for our clients, 0.5% to 1%. I mean, small amounts in aggressive models. This is not anything that we want to own in our core income driving models. So the core of our clients' retirement portfolios, we're not looking to own it. It's if you buy the Bitcoin ETF, it is something that you want to hold, I would say 5 years, but at least 2+ years. It is not anything you want to rely on for immediate returns or income. That's not the purpose of it. It is long-term growth.
Yeah, it's kind of like it's kind of like sugar. Like I recently gave up sugar so I could finally start losing some weight, and it's like, I gave it up for a while to kind of kickstart things, but it's like I don't want to give it up forever, but I just need to have some moderation in that, right? So I no longer do 30% sugar intake. I'm down to like 1%. To your point, Steve, right? So it's moderation.
Well, you look at the returns, and we have a lot of clients that do have this long-term bucket off to the side where it's like, we're probably never touching it. We're not touching it for the next 20, 25 years,
Right.
and it's eventually going to go to our kids. So we can get a little bit more aggressive, and maybe we throw $5,000 of that into Bitcoin or Ethereum, the second largest cryptocurrency, and see where it goes. Yeah. And then you look at returns. We got a Kalin chart. If we can throw that up, it just gives you an idea of how well Bitcoin's performed. I mean, you look at these returns, 5,516% in 2013, 37% in 2015, 119% in 2016, 1,300% in 2017. And it's the top performer out of all asset classes. But then you got to look at those other years, 2014, 2018, where it's down 60%, 70%.
Yeah.
You're going to have years like that as well. So it's not something you want to ignore, but it's also not something you want to take 30% of your money and pile into. You want someone experienced watching over it. If we put it in our models, that doesn't mean that we're going to continue to hold it in our models. We're going to take profits where the average investor goes, well, it went up 50% last month. I want to let it ride. Well, it just went up another 50%. Oh, now it went up 100%. If it just goes up another 100%, do you know what I'm going to have in this? And then it goes down 70%, 80%, you lose it.
Well, you got the Bitcoin millionaire, and then you got the Bitcoin ramen eating person, because it changes, right?
Yeah,
one day you're a millionaire and you're thinking about buying a Ferrari, and the next day you're eating ramen noodles. So careful.
That's exactly right. So the way we explain it, this is my favorite chart pretty much in all of finance, because it shows how Bitcoin is literally off the charts risky. So this is actually from Fidelity. So that's the thing, is we're going to be seeing commercials from Fidelity, BlackRock, all this hyping Bitcoin up.
Yeah,
So
great
it's
point.
one of those things. We talked about fear on the front end. Now we need to manage greed on the back end here. And that's where people can get in trouble, thinking, I want some of this return. So you actually look at Bitcoin here. It is 3x the return of your traditional financial assets, but also 3x the volatility. So you're getting paid, but it is a roller coaster that I'm not sure most people want to ride on. And I know most of our clients don't, but they still want to know about it. They want to know that it's something that we're looking at, we understand, and we could put it in our model if we find the right opportunity, or maybe even Ethereum, which we actually dipped our toe into last year. But it's nothing that a retiree should be looking at for a significant portion of their net worth. Like maybe that 60-40 portfolio becomes the 59-41 portfolio, something like that.
Okay, right.
But if you lose 80%, you have to expect it, and it shouldn't impact your life.
Yeah.
And I don't think we're going to see an 80% drop. We could. I think the ETFs are going to bring some stability to Bitcoin. That being said, a 40-50% drop would not shock me, but I don't think we're going to see the 70-80% drops that we've seen in the past.
You
I also don't think
that's going to help change the balance a little bit. Like it's going to kind of rein it.
It's going to balance it out, but that also means, a lot of people think, well, so I could throw, $100,000 in this and I could 20x my money. It could go to, no, I don't think that's going to happen either. I think that's already happened.
The Wild West part's kind of maybe.
Exactly. You could still see some really strong returns. You could double your money, maybe triple your money. I don't know, but you're not seeing the 20-25x anymore.
Yeah, no. Now that traditional finance has joined the party, we're a little bit more programmed to go in and buy the dip and just kind of keep throwing money at it, the index fund style. But we'll see. I mean, it's one of those things that's it's fun to watch, but it's not anything that we're over allocating to by any means.
Gotcha. All right. Is that our Bitcoin update for the first episode?
For sure. Yep. And I know this has been a hot topic recently with clients with these ETFs rolling out, and it's something we can do a deeper dive in if our clients want it, because we love to nerd out over it.
We'll absolutely do some shows on the whole crypto space coming up here and do a deeper dive. But we wanted to kind of cover it surface level. Matt wrote an article the other week. What was it? The Kentucky Derby. So you always make fun of the articles on my titles. Like, what was it? The Kentucky Derby.
Kentucky Derby begins.
Oh, I like that.
Pretend like that's not cheesy.
I mean, yeah, but it's kind of cool. Kentucky Derby.
Yeah.
All right.
I didn't come up with it. I stole it.
Oh,
Let's
you
have
stole? Okay.
Well, now you just ruined it.
But no, we definitely wanted to touch base. We got some additional questions from clients. Are you going to incorporate it in models? What are we doing here? Should I own it? How much should I buy? And again, it's something we'll bring up in meetings. We'll talk about it, but it's not anything you want to get too crazy with. And again, it's longer term money. So I mean, if we've got income taken care of, and you've got this bucket over here that we're not touching, then you can look to own some. But it's pretty subjective. You're taking on a lot of risk. But the returns could be there too. So,
well, I think that's going to wrap it up here for our first episode of the podcast, Retirement Approved. So we're going to have some stuff in the show notes. Feel free to drop a comment on the YouTube page there. Keep it PG-13 if you got a comment, you want to ask a question or whatever. We're going to start doing more of this stuff. We'll get some more interactivity going on, and of course, you'll find it different places. Like I said, Apple, Spotify, the YouTube platform, Shorts, all that kind of thing as well. So good stuff. Look forward to talking with you guys and doing more of these with Matt and Steve Paul from RW Paul and Associates. Find them at rwpaul.com. That's rwpaul.com. Or of course, just reach out to them if you need some help, and hit us up here on the various different social platforms. And we'll see you next time. Guys, thanks for hanging out. Great stuff. Looking forward to doing more of them.
Enjoyed it.
Yep, absolutely. We'll see you right here on Retirement Approved next time.
Retirement Approved is brought to you by Richard W. Paul and Associates, an SEC-registered investment advisory firm. Throughout the presentation, we may generally discuss different financial vehicles. However, nothing we say should be construed as a recommendation to buy or sell any financial vehicle, nor should it be used to make decisions today about your investments or insurance. For full disclosures, check the show notes of today's episode.